Something extraordinary is unfolding in Canada, and almost no one is prepared for the consequences. A housing market once celebrated as a model of stability is now showing the unmistakable signs of a controlled implosion, one that threatens not just homeowners, but the entire economic architecture built around them. For years, analysts warned that the country's real estate prices were mathematically unsustainable. But warnings are easy to ignore when values keep rising, foreign capital keeps flowing, and consumer behavior becomes anchored to the belief that homes never fall. Now that belief system is cracking, and the speed of the shift is what has global markets on edge. What began as a cool down has escalated into something deeper. Rapidly declining sales, surging inventory, deteriorating affordability metrics, and an uncomfortable question policymakers rarely say aloud. What happens when a nation's wealth is tied to assets that no longer rise? Here's the number almost everyone has missed. In several regions, new listings have jumped at the fastest rate since the last financial shock, while demand has retreated to decade-low levels. This isn't just a cycle, it's a structural inversion. And behind the headlines lies a quiet systemic vulnerability. Canada's economy is more dependent on real estate than almost any other developed nation. Construction, mortgage debt, and housing-linked consumption form a multi-trillion-dollar ecosystem. When confidence slips, that ecosystem reverberates in every direction, from retail to employment to municipal budgets. This is why global investors are watching with unusual fascination. For the first time in a generation, Canada's housing market is no longer the safe haven it once appeared to be. To the average family, this isn't about charts or forecasts. It's about the destabilizing moment when people question the financial assumptions they built their lives around. Mortgage renewals suddenly cost more than expected. Home equity no longer feels like a cushion. Young adults don't know whether to buy, wait, or leave the market entirely. In behavioral economics, this is the moment when collective belief can flip. And once it flips, it rarely flips back quickly. But the real story isn't the price drops. It's the hidden mechanics now activating beneath the surface. And those mechanics reveal a vulnerability far more complex than falling home values. Because what's happening next is the part no one is prepared for. The shock isn't that Canada's housing market is weakening. The shock is why it's weakening. Because the system designed to protect it is quietly working against it. Behind the falling sales and rising inventories lies a delicate machinery built on three pillars: debt expansion, immigration-driven demand, and institutional confidence. For over a decade, these pillars reinforced one another. More arrivals created more buyers. More buyers justified higher prices. Higher prices justified more borrowing. And the cycle spun on. But systems built on momentum face a unique danger. When the cycle slows, the pressure doesn't just reduce, it reverses. Interest rates expose that fragility. Households now carry some of the highest debt levels in the developed world, with mortgages structured in ways that make payment shocks unavoidable. As renewals reset, discretionary income shrinks, spending drops, and the broader economy starts to absorb the impact. Yet the most overlooked mechanic is on the institutional side. Banks, developers, and policymakers are trapped in a behavioral paradox. Acknowledging the severity of the downturn risks accelerating it, but ignoring it risks losing control of it. Developers pause new projects not because they want to, but because financing models no longer pencil out. Lenders tighten criteria because risk is no longer abstract. Municipal budgets, once buoyed by development fees and property taxes, quietly recalibrate. This is the psychological tension behind the crisis. Systems built on perpetual growth struggle to function when growth hesitates. For consumers, these mechanics translate into a strange, almost surreal environment. Homes sit on the market longer. Price cuts appear more frequently. Investors who once bought multiple properties begin to offload them. Renters wonder whether to sign another lease or wait for the market to buckle. Behaviorally, this is known as a sentiment inversion, a moment when optimism turns into caution and caution morphs into retreat. Once retreat sets in, price declines can accelerate even without a major economic shock. But here's the part nobody expected. Canada's housing turning point isn't just a Canadian story anymore. The world is watching closely because this shift could reshape global assumptions about real estate, wealth, and economic resilience. And as foreign markets study this unraveling, an even larger pattern begins to emerge. If Canada's housing market were collapsing in isolation, the world might shrug. But it isn't. It's part of a broader, quieter international correction. And nations are drawing comparisons that are impossible to ignore. Global observers see Canada as a test case, a nation with strong institutions, stable demographics, and a reputation for financial prudence is now wrestling with one of the most overvalued housing markets on earth. If it can happen there, the question becomes, where else is the same dynamic hiding beneath the surface? Real estate has long been treated as an anchor of economic confidence, but in the past decade, it transformed into something more speculative, more financialized, and more vulnerable to synchronized shifts in interest rates. History offers a sobering parallel. Markets rarely collapse because of a single event. They unravel when multiple stresses converge, rates rise, sentiment weakens, supply accumulates, and credit tightens. Canada's trajectory echoes patterns seen in previous international housing downturns, though with unique local amplifiers. But the global fascination goes deeper than economics. There is a behavioral dimension. Nations with rising populations and limited land often assume their prices are immune to gravity. Meanwhile, nations with aging demographics assume prices will soften slowly, not suddenly. Canada challenges both assumptions simultaneously. Foreign investors, once major players, are quietly re-evaluating allocations. International banks are modeling spillover effects. Even countries far from North America are analyzing what a sharp Canadian housing correction could mean for migration patterns, capital flows, and regional stability. For individuals around the world, Canada's situation acts like a mirror. Households in cities from Auckland to London to Seoul recognize the same pressures: stretched affordability, heavy debt loads, stagnating wages, and the sense that an essential societal pillar has drifted beyond reach. Behavioral economics calls this the global expectation reset. When one major market corrects, others begin reconsidering their assumptions, not because their fundamentals suddenly changed, but because belief systems do. And this is where the story deepens. Canada's housing decline isn't just revealing stress in one nation, it's exposing a misalignment in how modern economies think about home ownership, wealth, and growth itself. But the true impact, the part that touches households directly, is still ahead. The numbers tell one story, but the lived experience, felt by families, workers, and entire communities, tells a much more unsettling one. A housing downturn isn't simply a financial event. It reshapes how people plan their futures, how they spend, how they save, and how they move. Canada is entering a phase where psychological effects may matter more than statistical ones. When home values fall, consumer confidence often falls with them. People delay major purchases. They prioritize financial safety. They reduce risk taking. Small businesses feel the pullback first, then service sectors, then regional economies tied to construction and real estate employment. But here's the overlooked dynamic. A large share of Canadian homeowners are heading toward mortgage renewals at significantly higher rates. This isn't a slow drip, it's a wave. That wave compresses disposable income at scale, squeezing not only households but the economy they support. At the same time, younger Canadians face a different dilemma. Prices are softening, but not enough to offset soaring borrowing costs. The market doesn't feel more accessible, it feels more contradictory. This tension creates a generation unsure whether home ownership is a goal to pursue or a burden to avoid. Renters aren't immune either. As investors exit the market or struggle with higher financing costs, rental volatility becomes its own shock. This is why the situation matters far beyond real estate. When an entire society questions the viability of its primary wealth vehicle, behavior shifts in ways that ripple across decades. Migration patterns change. Birth rates adjust. Spending habits rewire. Savings behavior intensifies. and political and social expectations quietly transform. The media often frames housing as a story of winners and losers, buyers and sellers. But the real impact is systemic, a recalibration of how a modern economy functions when the foundation it relied on begins to slide. And yet, while this correction feels like the center of the story, it may only be the opening chapter. Because as Canada confronts its housing unraveling, an even more consequential shift is forming, quietly, out of view, and in a place few are watching. A shift that could redefine how wealth is stored, how nations grow, and how societies measure stability. Because while the world is fixated on this collapse, the real transformation is already unfolding, silently, and somewhere entirely unexpected.